What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we are going to talk about whole life insurance policies as an alternative to savings accounts and bonds. And I think this is a much more appropriate comparison than like comparing it to investments, because here's the thing, guys, whole life insurance contracts, they are not investments. They're like the polar opposite. Okay. So when I hear people talk about or compare investing in the stock market or real estate or even IUL, whatever, and comparing those things to whole life, they're not in the same category. You're comparing apples and tater tots, is what I like to say. They're just like the complete opposite. All right, so I want to break down why whole life insurance for me is a much better place to save money. So this is for your safe money, and I'm not saying that we shouldn't invest in our 401ks, IRAs, or the stock market, real estate, whatever it is that you want to do. That's fine. I'm not saying not to do those things, but sometimes people think that it's either or. I either purchase whole life insurance or I invest in the stock market or whatever. And whole life insurance, there's a lot of reasons why it's called the and asset, but it's primarily called that because it doesn't force you to choose between one or the other. It's really just a savings account on steroids that provides you liquidity and access to your money, assuming you have it set up and structured properly, of course. And we'll talk about that later. But assuming you have that set up correctly, you have access to your cash value in the form of a policy loan. And you can now take that and go do your other investing if you want, acquire other assets. You know, one of the ways that I'm going to be implementing it very soon, at the time of this recording, I'm learning the process for it, but it's private money lending. I'm not in a position where I really want to buy real estate at the moment, but private money lending, absolutely. And if you think about it, this concept of infinite banking, you know, if we're going to become our own bank with these whole life insurance policies, then, you know, if we need to start thinking like a bank. Like what do banks do? They lend money out, right? So private money lending for me is a really good opportunity to utilize my policy. I borrow, I pay, 5.5% interest, but I earn 12% interest over here while my cash value is still compounding every single year tax-free. That is a really, really powerful position to be in financially. So that's why for me, this is much more, these are much more like really, really good savings accounts that give you so many more benefits than your typical savings account. So that's what I really want to talk about today. I've got some notes here that I'm just going to use to kind of keep me on track here, because there's quite a few things that I want to talk about, just to give you a really good foundation about a really good way to think about the difference between these different assets, right? So if we're comparing them to bonds, so again, not saying not to invest in bonds or anything. It's not specific financial advice or whatever, but like for me personally, I still, even though I'm working on my second infinite banking cash value life insurance policy right now, I still have plenty of money in T-bills at the moment. I have money in high yield CDs right now because interest rates are high. Might as well, it's way better than sitting in a checking or savings account at 0%, right? So why not take advantage of these higher interest rates, put our money to work, right? But it's not the only place I have my money. And also, I'm not using it as a retirement vehicle. So, if we think about the traditional 60-40 portfolio or whatever, it depends on where you're at in like your retirement phase, I guess. But, a certain portion, like what's been recommended is a certain portion of your portfolios in stocks, for growth or dividends, whatever. And then the other portion is in bonds for more safety. And they're supposed to like cancel each other out, except does that always happen? Not really. And bonds are usually considered to be, really safe. And if you hold them to maturity for the income, that can be the case. Like, if we're going to hold it to maturity, do we really care about the fluctuation of the value of our bonds? Not really. But if you're in a position where you are relying on your bonds, like to sell them for income, then you can get into a lot of trouble. Like recently, when interest rates have spiked, the value of the bonds have typically plummeted. Again, it depends on what kind of bonds you have. But I'm saying if we compare it to whole life insurance, one of the benefits in that comparison for whole life insurance is that there's zero volatility because it's not based on any particular market, right? Like we're not invested in anything, right? It's a whole life insurance contract that has a guaranteed growth rate. It pays dividends as well. And so, when we look at the net internal rate of return of these whole life policies, it tends to be very close, very similar to bonds, depending on the company, depending on your setup, how you set up and design your policy. Typically the net internal rate of return of these policies is 3 to 5%, which is pretty close to what you would get with a bond. But let me ask you this. Again, comparing the two, with a bond, with whole life insurance, do you have the price volatility of bonds? Do you have to pay taxes like you do on bonds? Now, I suppose if you're doing municipal bonds, there's maybe an argument, but there's restrictions to that too. As far as municipal bonds being tax-free or whatnot, there's restrictions on that, and it can actually have other implications that people aren't aware of. But with a whole life insurance contract, our cash value is getting uninterrupted compound growth every single year, which bonds do not do. And it's growing tax-free, which most of the time bonds don't do. You get tax-free access in the form of usually it's policy loans later on, so it can create tax-free retirement income. Typically can't get that with bonds unless you're doing very specific types of municipal bonds. But also, if you passed away tomorrow, would your bonds, let's say you have $100,000 in bonds, okay? If you passed away tomorrow, would the value of your bonds at 100,000 all of a sudden blossom into $1 million or $2 million to be passed on to your loved ones tax-free without going through probate? Probably not. Well, life insurance, that's the case. It's a life insurance contract. The death benefit gets passed on tax-free to your beneficiaries, to your loved ones. It doesn't go through probate. It's safe from creditors, right? So taking, like a lot of the times when people are comparing these different assets, they always talk about the rate of, like they're comparing the rates of return. That is part of the conversation, but they often leave out the external rates of return that we get from these policies, meaning all of the other benefits that we get with the death benefit being passed on to our loved ones. That death benefit, guys, it also provides you long-term care protection as well. So if you get diagnosed with a chronic illness, terminal illness, sometimes specific medical conditions, you can access a large portion of that death benefit, usually tax-free, to cover those expenses. Can your bond portfolio do that? No. So again, this is not to discourage anybody from purchasing bonds. We want to be diversified and stuff. But from a comparison standpoint, for me, whole life insurance, especially when set up correctly, is far superior to any type of bond, at least that I've found. And so there's a lot of benefits to it. Let's see. I'm going down my bullet points here. Let's talk about liquidity and opportunity costs as well. So with bonds, let's stick on bonds for a second. And then we're gonna switch over to, I'm gonna start talking about savings accounts. All right. With bonds, what kind of liquidity, what kind of access do you have to the value of the bond? So are you able to borrow against the bonds? I mean, I'm not aware of any scenario or situation where that is a possibility. Maybe that exists. I don't know. But typically, if you need liquidity from the bonds, you got to sell the bonds or just wait for the income to be paid out, whatever it is, right? But you don't typically, from my understanding, you don't have a ton of access to those bonds without selling them. And God forbid you have to sell them when the value is down. Now you're just compounding the loss, unfortunately. But with a whole life insurance policy, we have access to our cash value to do other investments, to purchase other assets, to make large capital purchases, invest in our business. These are all things that I do right now in my own life. I've used my policy to purchase my vehicle, invest in my business. I'm going to be doing private money lending here very soon. All these things that we can do. But the thing is, while we are using that money, because we're borrowing the life insurance company's money and they're using our cash value as the collateral. All right. That's technically the equity in our life insurance policy. But while we do that, our cash value is still growing every single year as if we never touched it, because we never did. We borrowed the life insurance company's money. We didn't take our own money out. We borrowed the life insurance company's money. We go make our investments over here, do what we need to do. But then when we pay that loan back, the cash value continued to grow uninterrupted the whole time. So you made money twice, basically. And the cost is the interest that you pay on the policy loan, which is nothing compared to the benefits that you get and hopefully what you earned in your other investment over there, right? Can you do that with your bonds? No. So for me, the liquidity is such a huge benefit of these infinite banking cash value life insurance policies. If we talk about savings account, I mean, you can really apply everything we've talked about so far to the savings account. I mean, does it blossom? Like if you have $50,000, or we'll use the same example as the bonds. If you have $100,000 in a savings account, ask yourself, what is that doing for me? What benefits am I getting from this savings account? Maybe you're earning 1 or 2%. I don't know. It does provide liquidity. You have quick, easy access to it. But let me ask you this. With your savings account, if you have to spend that money, an emergency comes up, or let's say an investment opportunity comes up to purchase real estate or something, when you take that money and you spend it or invest it, what happens to it? It's gone forever. Okay. And the argument would be, if you used it to purchase an income producing asset, that's good. That's better than just spending the money and not having it earn anything. But here's what people don't ask themselves is what is the opportunity cost of spending that money? So if I take that 100,000 and an emergency comes up or whatever, and I have to spend that money is gone forever, and it's no longer able to produce interest for me. It's not able to earn anything. It's not able to work for me anymore. It's gone. With whole life insurance, that's not the case. I borrow against my cash value. My cash value is still there, and I slowly pay back that policy loan. My cash value continued to grow. I didn't lose. So for me, one of the most powerful benefits that we get, again, depending on what your goals are and where you're at financially, but for me, one of the biggest benefits with whole life insurance is eliminating the opportunity cost. It is incredible, guys. And actually, you know what? I'm going to share my screen really quick. I'm going to pull up a compound interest calculator here for you guys. Let me go ahead and share this. I want to show you just the impact that this has in our lives. And when I started to think about money this way, it just changed my life. It's just awesome. So I'm going to use a real life example for me. Okay. At the time of this recording, I purchased a vehicle not that long ago, maybe 2 months ago, and I used my policy to do it. And I specifically held off buying a vehicle for like 3 or 4 months. It probably wasn't that long, but I was holding off buying the vehicle until I got my policy so that I could borrow against it to purchase my vehicle. And here's why. So the car I purchased was $28,000. Okay. Let's do a length of time. I'm going to do 40. So I'm 35 right now. Let's go to 75. Let's say at that year, I finally decide to retire. I'm never going to retire, but let's say that's the year for me. All right, estimated interest rate. I always do 4% conservatively. That is usually around what the net internal rate of return is for these types of policies, depending on the company, depending on how you set it up. It could be 3%, 5%, whatever. All right, but we're just going to use 4% right now. Watch the numbers on this, guys. It's insane. So let me ask you, if I paid cash for the car and I didn't use my policy, did the car cost me $28,000? Or did it cost me $134,000 over the course of 40 years? Would I want to pay $134,000 for the vehicle? No. As much as I love it, no, it's absolutely not. And you think about this, this is just one purchase. This is one vehicle. Most people purchase multiple vehicles throughout their lives, not to mention all the other large capital purchases where we save up money. We pay cash for something, that cash is gone forever. And we don't think about the opportunity cost involved in that transaction. How much could that money have earned me over my lifetime if I was able to continue having that money earn interest and instead use somebody else's money to make my purchase, pay a little bit of interest, but I still have the compound growth over here, which more than makes up for the interest cost borrowing against the policy, right? I hope that makes sense. So like for me, this was such a game changer. One of the biggest benefits we get and why this is a so much better alternative than things like bonds and savings accounts. And here's the thing, guys. I still have money in savings accounts. I'm not saying don't have money in the bank, right? I have money in savings and stuff like that. But when I'm thinking about the money, the long-term money that I'm saving for building wealth and saving potentially for retirement, emergency funds, opportunity funds, things like that, most of that money for me is in my whole life insurance policies. I do have, instant access to the savings I have in the banking, in my bank accounts. But like, again, just ask yourself, what benefit are you getting putting your money in a specific asset? You want to write that out, think about it. And if here's I'm going to pull up my bullet points here. Here's a question I ask people is, if you're going to save money, why wouldn't you want to do it in the most efficient way possible where you get the maximum number of benefits? Doing the same thing, you're saving money. Why not get the most benefit out of it? Now, the argument that I'll hear from from people, and especially like IUL agents, is the hit that you take in the very beginning of your policy, because there is a cost to these policies. So if my first policy, I put in a decent amount of money. I did a large front load or lump sum. I didn't have access to all of it. I had access to a good portion of it, but I have a negative return, technically a negative rate of return right now. And that's because there is a cost. You're buying life insurance here, guys. You don't get anything for free. Okay. Just like, if you were to start a business, would you really expect to start a business with zero costs? Or are you going to invest a little bit into learning the skill set, maybe getting the location, whatever type of business that you're doing? There are costs associated in the beginning, but you do it because you know the benefits far outweigh the cost you're paying now. Later on in the future, those benefits are going to far outweigh those costs. So it's worth it to do it. Real estate, if you do like fix and flip real estate, you buy the property, you put a bunch of money into it, renovating it. Those are initial costs right now, but in the future, those costs are going to be recouped, and you're going to get way more benefit out of it over the long run. So yes, there's an initial hit that we take in the cash value and what we have access to, but when you set these things up properly, guys, it's not that bad, and you recoup the cash value pretty quick. In my first policy, my break-even point is like between year 3 and 4. My policy grows by more than what I put in by year 2, and I have access to about 85% of my first year cash value. I'm sorry, 85. I have in cash value. What I have access to is 85%, around 85% of what I initially put in. To me, that I'm willing to take that little bit of a hit in the beginning, or you can call it a big hit. I don't care, whatever. For me, when I understood the benefits and I compared it to other asset classes, it just made sense to me, right? Maybe it doesn't make sense for you. I'm not saying that this is for everybody, right? But it's important to know what your options are, have all the information, have all the facts. I say this all the time, guys. It's not that everybody needs to go in a certain direction, okay? Even though I would strongly recommend that a lot of people do this, it's not for everybody, and I understand that. But how can you make the best decision for you if you don't have all the information, if you don't know what all of your options are, if you don't know what the comparison, what the pros and cons of this are, and bonds, savings accounts, whole life insurance, like what do I do? All right. You have to understand how these things work, what benefit it brings to your life, and then you can make the best decision for you. Okay. So I'll go ahead and wrap up there, guys. What are we at? We're almost at the 20-minute mark. I hope that was helpful. I hope it's a couple of light bulbs went off for you, some questions to ask, and just to, get you to revisit your current financial situation. Make sure you're making the best decision for you. If you guys would like to have a conversation with myself or my team to see if infinite banking, cash value life insurance is best, might be good for you, I'll have links in the description. You can join the free community. You can book a call, whatever you want to do. If you just want to find out and just see if this might be a good fit for you, we'll let you know. All right. But either way, I hope you found value out of this. If you have any questions, drop them down in the comments, and I'll talk to you in the next one. To your success, Matty Ice is out.